He's also the founder of TrueCar, as you can see from the slides here, so it's probably a company that you've heard about that IPO'd in 2014. And he wrote a book, if 100 of you either have gotten or will get on your way out. And the thing that's always astounded me about Bernie is that the deals he makes are just amazing. You would think that the little startup things that he was founder of and we were working on together, and all the things that came after that, the ability for him to make a deal with the very top companies on the planet to be able to be nimble for his company, for his offerings, to be so nimble and give such leverage to not only his companies but those big companies. He's written a book. The podcast still going? No. Okay. And the charity's still going? So Bernie's also the founder of a charity called Thanks a Bunch. It gives benefits, or it allows you to easily give to veterans and military families and military members. And if that's not enough, he's the founder and CEO of his current company, Rollick. So he's here to share his journey with us, talk about raising money, being super successful at it, and hopefully inspiring us all to great things like the things he's achieved. Please welcome Bernie Brenner.
All right, everyone feeling okay?
Yep.
3 o'clock. Let's see, where's the clicker here? So I think this was titled Path to IPO, and Jeff and I had talked about some things in the past, and that's cool and all, but I think certainly what's relevant here with this group is really how do we get you to and through the A is probably based on the stages and the discussions that I've had with everyone here. So I'm going to focus on that, and I know we had a lot of questions that weren't answered, it seemed like, from the last one, so hopefully we'll just leave extra time to get to the questions and really get to the meat of it, because the goal here is for you to leave with as much knowledge, information that you can have specific to to your circumstance. So yeah, TrueCar was great experience. The story that I'll open this up with, because I'll close it later on as to how we did it is, the question is, if you had to enter a market and understand that the people you were going to ask, the constituent that you were going to ask for money from, revenue, had no interest in doing what you wanted to do, right? But this was what we as a company wanted to do this to change the industry. But the people you needed to go to had no interest whatsoever. How would you solve that? Would you go after it in the first place? It's pretty hard. And I'm not talking about the consumer here. And we figured out how to solve that, and I'll go through that. But that's an interesting question to ask yourself, is if you are looking for behavioral change, and more than just behavioral change, like I'm talking like operational change, right? What if you have to get that, how are you going to get that? It's not just as simple as saying, well, we're going to build it and others are going to do it. They're going to do it, especially if you have to ask them for money at the same time, because then you're conflicted. You want the money from them, but the thing you really need from them is actually they would perceive as not in their best interest, again, when you're talking about early on trying to change something. So if you're going to solve that, you really figure out how to do it. I'm going to talk about how we did it anyway and how I recommend going about it. And other times you don't have this issue. And I'm not talking about adoption on consumers doing a variety of things if you feel that they're eventually going to want to get there and it's in their best interest to get there, and they believe that. I mean, from a business operational perspective around change supposed to occur, you want it to occur, you're in business and you're starting your company primarily, I hope, to disrupt something, right? Because there's only 2 states to be in. And I tell this when I'm talking to big companies as well, which they really need to understand it. And it even applies to you as an early stage. You are either disrupting or you're being disrupted. There's no other way to think about how you're approaching the market. Because you will be disrupted at some point if you're not disrupted. Someone is going to do it better. So you have to think about that. So then how do you leverage the marketplace and assets and everything else to achieve what you want? Because you're either disrupting, and if you don't think you're disrupting, then someone is disrupting you. right? So it's the safest way to go about your business. And since you're entrepreneurs, you're all disrupting something, which is awesome. That's what I love. So, so I'll answer this about how we approach this at TrueCar in a little bit. But we started with this IPO thing. Ideas worth 100 million from VCs. We raised a little over 150 million before we went public. And that's okay on these. How do you do that? What do you do? Some of these ideas may warrant that, but many ideas don't, and it's not necessary. My current company that I started 2 years ago, there's no chance. One, I don't want to raise that much money, but there's no way it's just not. It'll never go public. It's just not. It's not worthy of a $2 billion valuation, and I don't want it to be, right? And that's okay. These companies don't have to be those big companies that go public, unicorn, whatever. There's plenty. Most companies sell for less than 100 million. That could be a really, really great exit, depending on how much money you raised, right? And the key thing to understand as you go through this, and I'm going to get into some sequencing on things, is the more money you raise and the more tranches you take, the longer it extends your runway to exit. All right, so you have to think about that too. Taking more money means, well, the clock starts ticking again, or resets, I should say. Back to it. Back to then what you're going to do. So the key thing about raising money, and I don't know what was covered in the other track, so I apologize if this is reiterating a variety of things, but when you're talking about raising money and angel and the story behind this, everything starts with the story itself. What is your story? And you better have a good one, right? What's included in a story? Well, clearly to do $100 million in raising, you need a great idea with a really big TAM, right? Not every market has a big TAM. The current market that I'm in is not a big TAM. But the difference is how I look at, like for me going from auto, which is an enormous market, it's one of the biggest TAMs you can get, to, let's say, recreation, which I'm in, RV, marine, power sport, much smaller. It's a tenth of the size. But when you do the analysis of that smaller market, there are many examples of achieving 50, 60% market share if you win. Where in auto, you'll never see that. Auto, like the BHAG is 10%. Right? You're lucky if you get 5%. And it's still really big. But so then you think about, okay, well, if I can get 50% share here, and I can only get 5% share in a really big TAM, well, my TAM just went up by 10x because I can get 50% share and it's reasonable. So those are the ways you have to think about some things. It doesn't mean that you have to go raise $100 million. You just have to figure out a way, what your story is, to make the market big, right? Or relatively achievable. And if it's not, then it's not worthy, and that's okay, of venture investing. And those are all the things that we have to come to grips with as we look at our business. Because fooling ourselves, it's just not going to work. Taking the money the wrong way, Claire said, even for angels taking advantage, and we're going to go through what it means to take the right money the right way, and how you can potentially get hurt. So obviously big TAM, and the bigger thing and the most important thing is team. We talked about that earlier. I'm sure you heard this from others. But team is everything, right? You have to surround yourself with the right team. And that could mean other founders. It could mean advisors, board members. There's a bunch of things there. But then you get to investors, right? And how are they included in your ecosystem? So clearly you need a variety of them if you're going to go raise $100 million, if you think you're going to potentially go public. And I can tell you, there's a lot of entrepreneurs I come in contact with, and they think their idea is the biggest idea and 100% it's going to go public, right? First of all, the probability of going public is very low. Second, it sort of sucks half the time. I mean, going public was not a phenomenal experience, right? It's hard. It changes your business. And I'm not saying in a positive way in a lot of cases. There are reasons to go public, and it is necessary for certain companies, and that's okay. But for, they'll come up and say, we're going public on this. When are you going public? 2 years. There's no chance. Right? But that's okay. They believe in what they want to believe in, very passionate. Me as another founder, I can connect with that passion, even if I'm sitting there on the investor side. And that's right, and I try and support them through it. And then that's also a good test to see whether the entrepreneur will listen to something other than what they absolutely believe is apparently fact, right? So, which is just not the case. So investors, and then of course, again, on this path of going through your series of raising $100, $150 million, then you have to continue to build momentum, right? You better do that. If you're teeing up a business to raise and raise and raise, there is a certain trajectory you have to be on, or it starts to get difficult. I mean, it's difficult already, but it starts to get a little more difficult. And then revenue, not EBITDA. I commented earlier that one of the companies I invested in, the CEO just wants to focus on profitability, and I'm saying you're a tech company. Like, what are you thinking? Like, this is not what we need to focus on right now. You'll get more enterprise value out of scale than profitability. Right? We need to raise another round. They care more about growth than profitability. That's what the money is there for. If you're going for profitability, then you don't need another round. Then your metrics change. Right? And so that's okay. That's okay. I'm not saying any one of those is right or wrong. It comes down to which path you're choosing to be on. Do you want to raise money or not? Do you want to raise from just angels and be out? Do you want to raise from institutional venture guys that are seasoned, right? That bring a lot more. So you have to think about all this as you're building your business plan, because these are the questions that early investors are going to ask you as well. And it better not be, we're going to go public in 2 years. I can tell you're going to lose a lot of credibility in that moment. Even if it happens, that would be great, but it's just not believable, it's not practical. Claire said the average exit now is 7 to 10. So what happens in 2 years? Nothing but a lot of pain, right? This is where we're all in. And that's okay, that's good, that's part of the process, and this should be difficult. This is not easy to do. Raising money is not easy to do. It should be hard. It's part of getting through and making sure that we're worthy of, in a sense, of building the company that we want to build. And then market power, right? So you're on this trajectory, you need to continue to build market power, or at least I do, I believe that, and that's how I built a series of my companies. All the way from the early 90s. How do you build more market power? Because I believe that if you can work in a way to change the dynamic in the market so that the market can converge on you in a way, it's really thinking very, very, very long-term, high-level, where are these push points that you can hit that will actually get the market to converge on you at some point. So investors, let's talk about that for a bit. So seed, pre-seed, seed, Series A, B, C, D. I said this earlier. I think the most important thing related to this series themselves is to label the round relative to where you're at, right? Not just a progression, of, well, I did a seed, so this has to be the A. Well, I did the A, so then now I'm in a B. It's not the case. Right? If you're not ready for a B investor, don't call it a B. B investors need certain things out of you as a business before they're willing to invest in you. But if you call it a B and you can't get them, well, the seed guys aren't interested in what's called a B, right? So you have to name your round, if you will, with where you're at, and where you're at may take longer than where you think. So if you did a seed and you still haven't proven what you need to prove, you don't have product market fit yet or something like that, well, then you're just extending the seed. Doesn't mean valuation can't go up, right? You can do a seed 1, a seed 2, that type of stuff. Those are things that are okay. But when you start calling it an A and a B, and the business isn't ready for it, you start to get yourself into trouble, right? And then you don't realize why until after it's too late. You've already pitched to too many investors, and you realize that was such a waste of time, and they're giving you the same comments all the time. So that's one thing. But in addition to that, from an investment standpoint, you really need to create, I believe, a solid board, right? It's not just your friends, right? And this happens. And you see this in a lot of cases where they're just, I shouldn't say a lot, but there are cases where people are surrounded, the entrepreneurs are surrounded, they're so fearful of a VC taking control of your business, which I said earlier is like the last thing a VC wants to do. Like they surround themselves on the board with people that are just not adding value to what you want to accomplish, right? And so you're not getting the most help out of them. But it's safe, right? That's not okay, in my view. You want to be smart, you want to add people, you want to get it, and as I said earlier, who was here in the earlier one versus the, okay, good. And then Good, okay, so there's a lot that weren't, that's great. VCs don't want to take over your company. It's the last thing they want to do. It's a black eye on them, right? So you just gotta, you have to round the board out, and you start with, maybe before they get on, maybe you just have a board of 3, then you go to a board of 5. You don't really want a big board, but you have to establish one that's really, really important. And then great advisors, right? You should be able to insert yourself in the ecosystem, and these advisors help you build credibility. But this is all part of the story of getting to where you need to be. The investors want to, it's all about risk mitigation, right? You're de-risking. You're de-risking by, okay, the idea is good, but the team is great. I think, I may say well, the idea is okay, it's good. It's not totally awesome, but man, this team is so good. It's a good bet. It's a good play. I can buy into this, right? So everything is around de-risking. So you're building your story around why it's smart for them to take a shot at you, from the angel on. And then the Right Syndicate. This is pretty important. I'll give you a story. There's a CEO that I know who, early on, it's a seed round, and this tech, it takes a lot of room in the lab, right? It's not pharma or anything like that, but it's a very technical product that needs to be proven out. And if it works, it's pretty big, right? So he attracted a strategic investor to come in for this seed round. And I'll tell you, that was probably one of the biggest mistakes he's ever made. It sounds so great. Oh, the strategic's going to be involved. They're going to get us this distribution. They're going to do this, they're going to do that. It adds so much credibility, right? So we'd all like a strategic. And why, everyone familiar with what strategic investors are? They're non-traditional VCs that have a business application to what you're doing. And generally speaking, they're valuation insensitive. Right? They don't really care about valuation as much as making sure that they're there, understanding, leveraging, being first to the table. If they need to buy you, they're already there at the table. There's things like that. A VC which is worried about valuation or thinking about it all the time. They think about it, but it's secondary to them making the business decision to invest in you. The problem with that is that, so this was his only investor, and now he needed to go back and get more money later on, right? The challenge with the strategics is they can change on a dime, right? It's a priority. We're doing investment this year. This is good technology. We have a fund for this. Next year, yeah, we don't want to do any more investment. And they can, if you're talking $1 billion company, $500 million company, whatever, they can write off that $3-4 million like nothing. And you're in a lot of trouble at that point. You know why? You're going to now you got to go raise money. And the first thing you say is, yeah, the big investor from my last round is not putting any dollars in. Huh, why? Let me hear this story. Right? You're set back a lot. It is tough. So while it might be really attractive, you might be able to get a better valuation, it's not necessarily worth it. I don't think it's worth it at an early stage at all. I'd never take strategic money at an early stage. I certainly wouldn't take it as the lead investor and the only investor. Right? So this is a big, big thing, and it's so attractive to go after strategic money if you can find them to do seed work, which is not common. But I think it's a big error. It's a big mistake for you all to consider that. Right? I would not take strategic money until probably the B, myself, and in the past I have not, because you don't want to price your deal too high too early, because that can get you into trouble. So if you're in the seed, you're in the A round, right? You're not out of the woods yet. Things can go wrong. And as I said, strategic investors are less valuation sensitive, right? It's not their primary reason that's not the primary decision. If you're overpriced, they can justify it or whatever, right? But if you're overpriced and things go wrong, they're not pro investors, and now you're in trouble. Now you're doing a down round. So I've heard from from entrepreneurs, I can get so much more, I could get a higher valuation from this group. That doesn't mean it's the right one to do. It sounds really good, but it's not right. And I know it's counter to what we all think about, but you have to think about if you're going for these longer raises, going for the A, B, C, and D, when you're doing this round, you have to think about your next round while you're doing it. right? What does it mean? How does this set me up for the next round? What happens if things go well? What happens if they don't go well? Who's in? Who can I get? Where do I need to be? How much would I raise, right? So you think about your next round while you're doing this round. And if you're doing things in this round that you think are going to jeopardize the next round, you have to rethink how you're doing it. It's really, really important. So the Right Syndicate, let's talk about that. So I gave you an example where there was no syndicate. Syndicate meaning multiple investors in on a deal, right? Not just one, hopefully 3, depending on where you're at, maybe 5, right? It's nice to have a lot of checks around the table. A lot of entities that can write a check, because things are going to go wrong. They never go as well as we think, right? I mean, I personally, I don't think I've ever hit a projections, for a pro forma I've ever created in terms of the fundraising. Why? Because things happen, and the investors know it. They understand this is what you're thinking. This is what could happen. Sure, it's nice, but that's why they invest in team, and that's why they okay, what can go wrong here? And it's not bad to identify what can go wrong, because it's legit. It's real, and you're demonstrating that you're prepared for it. But getting the right syndicate also helps you personally with downside protection. Because if you have to go back to the well, you have to do an inside round, you have to do a bridge because you're not ready to do an outside round, you have to call on your professional investors. That's what's good about a VC. Right? Angels can get you so far, but it's going to be hard for angels to power you through a downside. A rough patch, I should say. So when you get to the A, maybe on the seed, I took VCs on the seed side. We did a large seed on this last one, on my current deal, Rollick. But I had VCs that had 3 there, and now I have 6, right? And I specifically made room for the 6th versus giving more allocation to the others that were already in. They got their pro rata because they required to get that, but they all wanted more, and I said no. I wanted room for a 6. Why? Because things could go wrong. Even when things are going right, we have to prepare that things are going wrong. So having 6 around the table is a lot easier if you need to bridge for everyone to write a check for whatever, $250, than having 2 guys around the table that have to write a check for, $5, $750, whatever it is that you need each. So think about that as well while you're going through these stages. Angel investing is really, really important to get us off the ground, right? And at some point, you're going to sort of graduate beyond that to these professional investors, and they are very valuable to us, right? So I have a lot of respect for them and the process that we go through to bring them on. But how can you screw yourself? And you can. So as I said, they're VCs. They're not vultures, right? You don't really have to be worried. And I'm only saying this because I've really talked to a lot of entrepreneurs that have said, I don't want to take any VC money because they're going to take my company. It's not true. If they're real investors, if they're professionals, and they're not, there are angels out there that will try and take advantage of you, and they don't really understand how they're screwing themselves later on, with those terms or when they get into terms. And then strategics can really screw you if you take that money too early from them. I would recommend not until a B, because then your valuation can be higher. You've proven enough, right? It's less likely you're going to be in a position where you'd have to consider a flat to a down round. And I'm not talking about really overinflating your valuation. I'm just saying you're at the top end of it, right? We got to be reasonable about our valuations at the same time. So terms are very important here, right? So where can you get into trouble on those? And the reason why, if you have VCs, first of all, it starts with is it good times or bad times? Right? Because right now it's good times. There's a lot of money flowing out there. There's a lot of money sitting there that wants to invest. And I'm talking about as a broad group here. So we're not, this isn't, I raised money after 2000 in one of my companies. It was that $2 million was one of the hardest things I've ever done in my life. I mean, VC money dried up. Every .com had already imploded. And I needed to power through, and it was really, really, really hard. In those circumstances, terms are going to change and terms are not going to be pretty, right? Because it's a risk-reward situation. And that's okay then. But in times where they're reasonable, right? They don't have to be phenomenal, but putting onerous terms on an entrepreneur, on you all, is actually hurtful to the investor and to you. They think they may be getting a good deal right now, but they actually could be screwing themselves later, but they're certainly hurting you. And so think about like liquidation preferences. All right, so there's a bunch of terms, but I think the two, other than valuation, the two major ones are liquidation preferences and anti-dilution provisions. And what do they look like? All right, so liquidation preference, for those of you who may not be familiar, that's a scenario where I put $1 million in, right? And generally you have, and I'm getting preferred stock. And I have something where I get a liquidation preference, meaning at least I'm going to get 1x out. Sometimes it's 1.5, sometimes it's 2. So that's a variable in that. That's a fill in the blank, right? During good times, it's 1. It's reasonable. 1 is it's reasonable to say if things aren't going well, you put $1 million in, you can get your $1 million out before everyone else participates, meaning the common. And you all, as your founder shares, only have common stock. But it could also, there's another component to that, which is I participate as well. Right, so what happens is you put money in, and it's either I get my 1x out, or everyone converts to common, and then it's just, if the number's high enough, and then it's just a percentage. I own 10%, and it's a $100 million business, so I get $10 million, right, for my $1 million that I put in. But if we ultimately sold for $5 million, well, 10% is $500,000, not $1 million. I get my $1 million out, right? Some terms are, which I think are onerous, are personally, as I'm sitting on the side of the entrepreneur now, is, and I participate, meaning I get my 1 million, or I guess 1.5 or 2 if you've agreed to a 1.5 or 2x liquidation. Plus, then I also participate on the common. That's a no-go. Right, now I can say that's a no-go. It's a lot easier for me to say that's a no-go because I'm not pitching a deal right now, but sometimes you have to take what you have to take. But I'm just letting you know that that's difficult. Why is it difficult? Partly because it could hurt the common, your employees, things like that for a liquidity event, but also you're setting the stage for the next round. Right, so now the VC comes in, the next one comes in. Oh, because they'll say, send me your last term sheet. Always, they say that, right? Oh, I see there was 1.5 liquidation plus participation. Okay, I'm getting that. So once you're in it, it's hard to get that term out. So it compounds, and it's really, really hard. It's rough on us. So you want to avoid that. The other thing is anti-dilution, right? There's an anti-dilution provision that's common. It's called weighted average, and then there's something called full ratchet. All right, full ratchet means if you're doing a down round, my money goes in as if it was that low valuation, right? Or weighted average means it blends out with everyone else. Once you get full ratchet in, the next guy wants full ratchet. So these are things that you want to make sure that are not, I recommend, are not in your term sheets, if you can avoid them, right? And you can talk to your investors about that. And you can say, well, this sets the stage for the next one. This is going to be a challenge, right? And a lot of times, the new investor may come in and say, you have to renegotiate some of those because I don't like those terms, whatever it may be. Right, so that's another headache. So it's not just getting the money, it's not just getting the pitch, it's getting the right terms. I cannot stress that enough. It is about building the right relationship. And if someone is going to give you, whether it's an angel or a VC, really bad terms to take advantage of you, hopefully you can walk away from that. I hope that you can, right? Or you can talk them into a more reasonable position, but just keep in mind that they did ask for those. Right, and they do. I hope well, maybe they don't. Maybe the angels don't anymore. Understand that they are setting you up for some difficulty later on. We will be in a difficult position unless things go really great, a lot of the time. So that's the term. Now, valuation. That's another interesting discussion. What determines valuation? Whatever you can get. I mean, sometimes there's an equation to it, but not really. It's what you think you can pitch, what you can communicate, why your team is who it is, what the TAM and the SAM are, and all this other stuff to get to. I'm going for this, and they say no. If you're fortunate enough to have multiple term sheets, then you can triangulate on that, and then you can start using the multiple term sheets to get that valuation up. And the other thing that's important, I think Claire said this earlier, is certainly for me, I always go outside of my market too. So my lead VC on my seed, local Austin. Then I got an LA firm and a Northern California firm. Right? On the a different Austin VC. Everyone from the Series C participated. And then still 2 new firms. Another LA firm, and actually this firm out of Iowa. So, so that is very, very helpful as well. So think about it that way. It is okay to diversify geographically where these guys are. Because you start, they all see different valuations. Right? So it'll help you, and it just helps with their knowledge, their network. There's a variety of ways. So this whole thing about the Right Syndicate is really, really important. All right? So I want you to think about that as you're raising capital. As not just, there's a syndicate of angels, there's a syndicate of VCs that you can go through that can ultimately help you and leverage what you have and what they can bring to bring more success. But back to where you can get hurt. You can't, if you have to cave on a term and it's really an owner's one like one of these, it can hurt you, right? And it's reasonable to talk to them about that. And they may say, you know what? Hey, I'm the only one at the table. This is what it's going to be. And then you have to make a business decision. Is that okay for you to take it or not? It might be. It's nothing personal, right? It's not a personal thing. It's just their philosophy. But you know for the future. Let's just make it very, very clear. When everything's going great, all these guys are great. They're all awesome, right? The proof comes out when things aren't going well. And you got to go back to them. And how they deal with you and treat you and step up for you is extremely telling. So you'll get a little window into that when you're negotiating the term sheet. But just understand that they all sound great, but when it hits the fan, you see who really can step up and is reasonable about their risk and return, but not too onerous to hurt you in this process. You got to power through a rough time, right? And so that's not the time for an investor to take advantage of you. Frankly, that's when you need the most support. Okay, so market power. This gets back to the story that I talked about earlier and the Sumo Advantage and creating an unfair advantage. Right? The Sumo Advantage is this concept of aligning with you're a really small company, we're in this, I've been in your seat and negotiating these very large deals, strategic deals with Fortune 500 companies. So it's hard to convince them to even take your call, let alone actually structure and do a deal with you. But it's possible. I've done it multiple times, so there's proof that it can be done. And you really can create this unfair advantage. It's a sumo versus the gorilla, because gorilla is about, the big whale is about closing the sales deal. This is about going and getting a company that is a warrior, that works in a ring, understands the rules of engagement, and you, as the entrepreneur in the smaller company, can leverage that sumo's weight in your battle. So you're standing there and the sumo is behind you, or you're on the sumo's back. That's this concept. And your market power, right, your momentum, your credibility, raising capital, I call these, when you get these deals, these are valuation doublers. Why? Because it de-risks the deal so much. Doesn't mean that there's no risk. It just means that it greatly validates what you're doing, right, and de-risks for the investor when they're considering how this is going to progress over time. Now, managing the deal, that's a separate, we're not going to cover that today, but how do you get the most out of the sumo? That's really hard. Because after you get the deal done, again, this is not sales. The difference between sales and BD is primarily, there's 4 main things, but the sales is about a transaction, right? I sell you paper cups, you give me money. Super simple. You want more paper cups? I send them to you, you give me more money. Everything's governed by that transaction. In a partnership deal, there's no money to govern the relationship. Right? You have a contract, nothing has happened. It was hell to get the contract, and nothing has happened. You then have to go make things happen. And that's where most entrepreneurs fail on the partner side. Because they don't know how to make it happen. They put a, quote, account manager on it who thinks that they're going to service it like a sales deal, except there's no transaction that governs the relationship. Right? It's so great to have the transaction there. I order paper cups, I want the cups. You want them there in 2 days, I'll FedEx them. Great, you're going to pay this, that. Oh, the paper cups didn't show up, you get to beat me up verbally or whatever. I have to FedEx them there again. Bam, it's done. Right? And you either service them well or you don't, and then you lose the contract on it. That doesn't exist in this partnership world. But it is really valuable, if you can do it, to pursue this strategy, because it does give you an unfair advantage, and it does accelerate sales. So let me give you the answer to that first thing I opened up, which is how do you get this behavioral change when the companies that you're going after don't even want to do what you want to do, right? So that's TrueCar. New car dealer in the country offering upfront pricing on a new car. Right? There was no price discovery on that. This is something that we felt like this was a good endeavor to go after. The market was ready for this. The data is available, right? Everything is in some sort of electronic form where we can capture it and build on it. And but the dealers, and we've truly believed, by the way, it was better for both the buyer and the seller. The dealer will actually make more money if the auto dealer focuses not just on that transaction, but on the relationship and the lifetime value with that company, with that customer. And it's really true. This is proven in so many other ways, right? But yet this group was hesitant of that. They didn't like price discovery. So imagine we start a company, we raise money, and we knock on these dealers' doors, right? And we knock on the door and say, hey, Mr. Dealer, we're starting this new company. It's called TrueCar.com. I know you've never heard of it before, but here's what we're going to do. We want you to sign up, and we want you to give an upfront price on every car on your lot, every new car. Right? Oh, and by the way, we also want you to give us access to your dealer management system. We're going to take all of your consumer data every night and match it to sales. You're going to give us all your customers. How do you like that? And if they didn't shoot you, then maybe they ask the question, well, how many customers do you have? Well, the answer is we don't have any customers right now. We've got a chicken and egg issue. We need your data. We need your cars. We need everything before we can go get customers. Well, what's your quality going to be? It's going to be high quality customers, low quality customers. Well, we think they're going to be high quality customers, but we actually don't know because we don't have any customers because we need you to do all these things for us, right? So the answer is just flat out no, right? So approaching the market is not going to work. We would never have gotten off the ground. But instead, we chose a Sumo approach. And our first big deal was with, let me go back into it. Instead, we chose the Sumo approach and said, all right, how do we get power in the market where then these dealers who don't want to do this are willing to do it? And for what reason? Is there a compelling reason for them to do this with us? Right? And you got to create that. That's our job. They shouldn't just sign up willy-nilly. They should sign up because there's a really good, compelling reason to do it. So we chose this partnership strategy. This sticker's killing me here. So here's an example. This is what happened. We didn't launch as TrueCar.com. We launched as Geico and Sam's Club. And the first one we launched with was USAA. Right? So this is our website. Anybody familiar with USAA here? Yeah? Amazing company. One of the best in the world. Certainly the best consumer brand in this space, the most loyal customer base. They are unbelievable. They're incredible. Right? And to that brand and any service that they offer their members means a lot. So you got to live up to their brand with this partner strategy as well. But we were able to do this. We were able to convince them of that. We were the first non-AAA rated company to ever do a deal with USA, let alone we had no revenue. Right? So it is possible to do these things if it's set up the right way and it's compelling for them as well. But anyway, so now imagine going and knocking on a dealer's door. Because remember, the strategic deal does not get you revenue, right? But the strategic deal helps you accelerate your revenue with your sales team. So now the sales team is out there knocking on dealers' doors. Hey, Mr. Dealer, you want to be part of the USA car buying service? Yeah. What do I need to do? That's the response. Now, then when you say, oh, you got to upfront price every car, you got to give us access to all your customer database, whatever, then they start to fall off. But at least you get to that point, right? And then you get ones to sign up to say, you know what? To get access to USA members and for me to be a USA certified dealer, yeah, I'll change my behavior. I'll do those things, right? And then they're going to win. I mean, in theory, and then we have to prove that they did, and they did. So that's the way we approached it. So think about your business and what you need to change or get adoption. And if you have this type of hurdle, then you're going to need something other than a really great pitch and something that's, it sounds like it could work, right? But that brand. So at that point, we are a startup, but to that dealer, we are as large as USAA, right? We are now as big as they are. No question in the dealer's mind. right? So that's what happened. Suddenly we're now this enormous company. Of course we're not, but we represent that to the market. We have that much market power. And that's what allowed us to raise so much money. And we ultimately got to 500 partners, right? Because part of it was a strategy around just suck all the oxygen out of the room, get every deal, every partner you can. Obviously the 10 or 20 that matter are there, but get the rest so that as part of this competitive moat, which investors love to see. If anybody else wanted to enter the space with that strategy, where were they going to go? Who could they possibly do a deal with? There's no one left. Right? So that's part of a strategy as well. So when you're all thinking about a BD strategy, and this is something I run into a lot with entrepreneurs, they say they want a BD strategy. They say they want to go after partners, but they don't have the commitment to doing it. And that means there's no ROI on partnership strategy for at least a year. Really, it's 2 years. Right? It's a long process. It takes a year to get these deals. Right? Then it takes another year to just sort of spin them up right. And then it starts to take off from there. So there's a lot, and it's okay if you don't have the patience for that right now. But just accept that about yourself and say, oh, I'm going to do that later. That's okay. That's not a priority right now. Priority right now is product, whatever. Minimum viable product, product market fit, team. There's a whole bunch of things that can trump this strategy. Right? But at some point you can use it, but you have to be committed to it. And it's not something where you say, I'll give someone 3 months to do this. It's just stop right there, save the money, because it's guaranteed to fail. Right? So that's pretty much the difference there. So what is your story, this whole concept of investors and, wow, this really didn't matter. Sorry about the overlap there, but the Right Syndicate, I want to stress again, is something, and the terms around that are really, really important. So with that, that's really all I have to cover for now, given this topic, and let's just open up for as much questions as we can.
You got it right. I think we got time for. Should have.
We have 4 minutes. I told you I was going to leave enough time for these questions.